Anyone want to venture a little definition for us? Shout it out. What is blockchain? Distributed trust. I like that. That's nice. Wow. Anyone else? Maybe a more practical definition? Something complex. I'll take that. One more. Third time's the charm. Come on, guys. What is blockchain? I'll give you a hint. It got popular with Bitcoin. Distributed ledger. There we go. That's what I'm looking for. Ledger. So you clearly already know something about blockchain. I know a little bit about blockchain. The guy I'm about to introduce knows pretty much everything about blockchain, if that's fair to say. Please welcome Nick Weisfeld. He's the head of data practice at GFT Technologies in the UK. Welcome, Nick.
Thank you very much. Cheers. Thank you. It's very much an honor to be here today, presenting to you at Europe's largest innovation festival. My name's Nick Weisfeld, and I co-head the GFT blockchain practice with my colleague Julian Eyre, somewhere in the audience today. Today, I'm going to share with you my thoughts on the primary business cases for blockchain. Before we start, here's a little bit background to GFT. We are a business and technology consulting firm with 4,500 employees. We focus primarily on financial services industry, and I've drawn on my experiences from the financial services industry today for this presentation. We're a founding sponsor of this innovation festival. At GFT, we're very proud to be at the leading edge of innovation in financial services. Not only does our research and development investment help our customers to achieve their objectives, it also makes GFT a really interesting place to work. I am now in my 11th year at GFT, and I cannot express how interesting it is to be working with GFT and its clients on this exciting and novel technology. There's a lot to cover, and I want to leave some time for questions. I'm not sure I will have some time, but let's move fairly rapidly through this presentation. So next slide. Here we go. This is the Gartner hype cycle. You're probably aware of this. It's a standard model for showing fairly high level the maturity of new trends as they go from initial thoughts through to productive solutions. Here is the most recent publication. Blockchain sits comfortably amongst the latest technology trends, including the Internet of Things, the 3D digital printing, and is slightly ahead of AI. Although Gartner's researchers feel that this emerging technology are close to reaching their disillusion phase, my view, having been involved in blockchain over the last 18 months, is that there's significant disillusionment towards the end of last year. And we may now be entering the slope of enlightenment for certain aspects of blockchain use cases, especially in UK and North America. For other markets, I still think there's a lot of hype, and the hype is still increasing. In the US, Israel, and UK, we are beginning to see some targeted investment with specific products and services, which leads me to think we're getting to the plateau of productivity. Yesterday, I investigated the trending of the term blockchain on Google's search analytics site. This is their results. You can do this for any term by going to Google Trends website. This graph is the global trend for the previous 5 years and shows the volume of searches relative to the peak volume. The trough here, right at the end here, started on June the 23rd following the Brexit vote. And I guess that's because everyone was doing other searches at that time. But what's interesting is we're past that trough now, and we're back to the pre-levels of interest in blockchain. The exponential upward trend started late last year, which coincided with the point at which mainstream media outlets started to get interested, in particular with the in-depth articles published by The Economist, The Financial Times, and they were saying basically detailed research on how it's going to change financial services. It should not be a surprise to anyone that there's a strong correlation between the general levels of interest in blockchain and the levels of investment pouring into the leading blockchain fintech firms. As at the end of 2015, there was a total of $500 million that was invested in both Bitcoin and blockchain. Investment in blockchain alone stood around $300 million at the end of H1 2016. And this is despite a background downward trend in global venture capitalist funding. And just last week, very importantly, we saw Ripple announcing $55 million worth of funding. This is significant because Ripple are developing a protocol for interoperability between private blockchains within the financial services industry. Historically, in my opinion, when standardization starts to develop in bleeding-edge technologies, and in particular, practitioners start to back specific protocols, this indicates a certain level of maturity within that field. Even so, this investment is currently for future returns, and it remains to be seen whether it drives expected revenues. Right. So what is driving venture capitalists to part with their money and invest in blockchain? It is fundamentally an implication of cost. At GFT, we recently coined the phrase the new normal. This describes the new reality that banks are currently facing of reduced margins, low returns, increased competition, and ever-increasing regulation. The question that many people in the industry are asking themselves is how do we drive customer and shareholder value whilst refreshing legacy systems and outdated technologies and the related infrastructure? It is this new reality that's driving the discussion forward and is leading to new and unexpected conversations between firms on how they can collaborate with each other and ultimately drive or thrive in the new normal and survive. So R3, I don't know if anyone knows about R3, I'm sure there's people in the audience that do. R3 is a perfect example. It is a consortium of financial services companies set up in 2014 by an ex-FX trader, David Rutter. His primary objective is to promote the collaboration between financial services firms and to drive blockchain forward. Here, many of the world's largest banks get together every month and talk to each other about how to leverage their blockchain investment. Why are these discussions taking place in a consortium model? The reason is blockchain fundamentally requires these organizations to work together as never before. Some are skeptical about whether R3 will achieve anything significant. What is clever about R3 is that they've agreed a legal framework for collaboration between participating banks. Let's be clear, these banks do not trust each other and typically do not share their IP with their competitors. It is under this legal framework that banks have felt able to have an open dialogue with each other. Some may argue this is financial services industry protectionism. Whether it's protectionism is the main driver or not, I believe that due to this new reality described earlier, the time has never been better for the introduction of radical approaches to addressing age-old industry problems. It is now or never. So what exactly are these industry pain points that are driving this radical approach? Here are my views on the drivers for change. There's quite a lot here. I'm not going to go through everything, one of them. I'll focus on two aspects of this: high cost and lack of transparency, the first two. Banks inherently don't trust each other. This lack of trust has a number of consequences. To deal with this reality, banks prefer to transact with an independent third party that can help manage some of the risk. The idea with blockchain and distributed ledger technology is that every participant has a shared and current view of the market, and this is cryptographically guaranteed to be identical. Interbank transactions are committed to the distributed ledger as an immutable fact, or to put it another way, a golden record. Each party to a transaction can view at any point in time. This transparent paradigm provides trust without the need for an intermediary. The model shown on the left requires infrastructure, process, people to deal with the lack of trust. Every step requires reconciliation, both intrabank and interbank. Although the diagram on the right looks more complex, it negates the need for people, process, and infrastructure to manage the lack of trust. This is where the potential for huge cost savings is seen. According to Ripple, the estimated value generated by the application of distributed ledger technology to cross-border clearing and settlements is 50 to 60 billion US dollars on a cost base of 150 billion per year. These are serious sums. Okay, let's now move on to how to innovate using blockchain. This is a famous quote attributed to Henry T. Ford. You might recognize it. I think it's applicable to the blockchain innovation. With blockchain innovation, there's a danger that the technology is applied to refresh legacy processes where existing or more suitable technologies would suffice. Faster horses. Conversely, those responsible for multi-year investment programs that are about to kick off or are currently in flight should consider the implications of blockchain technology on their target operating models. They should do that now, otherwise there's significant danger of their solutions being redundant before they go live. At GFT, we therefore recommend to looking at the impact to the full value chain when innovating with blockchain. This diagram is produced by in one of our design sessions. We were looking at how blockchain could disrupt the metals commodities industry from a metals producer's point of view. To do this, we looked up and down the commodities value chain and analyzed the data flows between various actors within that chain. We then looked at how blockchain-enabled business model would change that industry. That is not to say that engineering a single business process within a single organization should be dismissed. This is a question of scope, and once the implications are understood, it is often better to start with a defined and limited scope and build out from there, a proof of concept, if you like. This slide shows how we at GFT determine whether a particular use case is suitable for blockchain innovation or not. You should assess all use cases against these or similar criteria, and if a significant number do not reflect your business landscape, then it's probably not suitable for blockchain. Let's now move on to some of the use cases in financial services that meet these criteria. The first one, and the most important one in my view, is payments, and especially micropayments. They have a very, very strong focus right now. Venture capital investment and bank R&D effort is proportionally high in these particular fields. The reason are that the current cross-border payments, clearing and settlements value chain is costly, inefficient and opaque. A distributed ledger solution applied to cross-border clearing and settlement process will enhance transparency, minimize settlement risk, lower cost and increase transaction speed. Existing domestic payments systems are based on trusted central authority like the Bank of England. Cross-currency international payments have no central authority. Distributed ledgers could therefore be a good fit for international payments. The Royal Bank of Scotland and GFT have just finished developing a test solution that does exactly this. We call this Project Emerald. We're about to publish our results on the scalability testing performed during this project. For those of you who doubt that the existing implementations of blockchain can scale to domestic payments volumes, I can tell you here now exclusively that with some code changes, Ethereum, which is one of the major technologies in the field, does scale to domestic volumes of about 100 transactions per second. If you want the detailed findings and my reports and that we co-wrote on this, come and see me afterwards. Another big bucket of use cases is physical asset management, whether that be diamonds, commodities, bonds, or property. All these physical assets live through a long life cycle. Even a bond has a physical piece of paper sitting somewhere in a vault, in a bank vault. Providing transparency through a distributed and trusted golden source record of asset ownership and location, and maintaining that throughout its life cycle addresses a number of pain points that currently require operational process, systems, and reconciliation through intermediaries. Once you start looking at the end state, the implications to asset finance, trade finance, logistics, collateralization, risk, and fraud become clear. As mentioned earlier, GFT has done significant R&D in this space, and one of the key areas that needs to be addressed is how to tie physical asset blockchain to a blockchain golden record. One of the finalists here at CodeN is Everledger. They have addressed this concern for their diamond blockchain solution by creating a unique record of that diamond based on its inherent characteristics, size, shape, grade, and clarity of the diamond. Another area gaining a lot of interest is the post-trade functions of an investment bank. Once a trade is struck between two banks, there are huge amounts of operational processes to ensure that the trade executes correctly or to deal with the consequences of it failing. These activities include trade confirmations, clearing, settlement, cash transfer, corporate actions, and collateral management. Most of these processes have their own unique set of intermediaries. Here, the thinking is that if these intermediaries can be reduced, the addition to cost implications, the time it takes to execute a trade could be vastly reduced. This could improve the overall liquidity of the market and go some way to address those pain points of the new normal we discussed earlier. I'm going to skip that because we're running out of time. The final use case I want to go through today demonstrates the potential of disintermediation across many industries, not just financial services. The use case relates to Uber. Uber took the concept of hailing a taxi and created an app to do this online. To make it work, they undercut the competition on price. For consumers, the cost of using an Uber taxi are significantly less than a London black cab. Consumers therefore love Uber. However, the drivers may not be so keen. Uber needs to make a profit. They cannot, however, raise prices, as this would drive business back to the competitors, so they squeeze the amount of money they can pay the drivers instead. Christopher David here, with the beard, it used to be a Uber driver in New Hampshire. After yet another fare reduction, he decided to leave and take on Uber using blockchain. His company, Arcade City, is developing a distributed ledger solution that puts the driver in direct connection with the consumer. The idea is that this service will be able to deliver the same fares to the consumer, but because there's no centralized service taking a cut, more of the fare goes back to the pocket of the driver. There's a long way to go, but I think this demonstrates an interesting point on the implications for blockchain in industry, in the wider industry. We've covered some interesting applications of blockchain in financial services and beyond, so we should now consider some of the problems that this technology currently faces and needs to overcome to be successful. Bitcoin and Ethereum are both open source public blockchain solutions. These solutions have a number of properties that ensure that they function well in the public domain. You may have heard of things such as proof of work. Whilst these functions are essential in public distributed networks, they are not so important in private blockchain solutions where the participants are known. These functions also reduce the ability of these platforms to scale to current payments and trade volumes. In the Emerald project I mentioned earlier, we had to recode the core elements of the Ethereum platform to either disable these functions or reduce the impact on scalability. A second important shortcoming relates to smart contracts. Smart contracts are self-executing code that represent legally contractual documents. The question that is puzzling the blockchain and legal communities right now is how to precisely represent a legal contract in the code of a smart contract. The question often posed is whether the lawyers need to become coders or whether the coders need to become lawyers. Some are exploring the creation of a domain-specific language that can encode legal documents. Many lawyers question whether this would stand up in court. There are a number of other shortcomings that are represented on this slide, but we certainly don't have much more time left, so I'm going to skip on to my conclusions here. So the conclusions, what have we learned from this presentation? Blockchain is trending, we can see that. There's significant appetite for investment. The technology is maturing. The time is right now for significant change and disruption to traditional vertical industries, especially financial services. Payments, micropayments, assets, post-trade re-architecture are prime use cases that stand out from the rest. And from my experiences, there are a lot of very bright people giving up their well-paid careers in banking to spend time innovating in the blockchain space. We should not forget there is a number of key hurdles that need to be solved before solutions become a reality. If we do overcome these, then I expect blockchain will be similar to the internet or the HTTP protocol and become part of our everyday lives. That's the end. We have another session that's going on at 3 o'clock on Connected Mobility World, which is a panel session with Hewlett-Packard Enterprises. So if you want to ask me direct questions and my colleagues, then please come and see us there. But thank you very much. I'll take some questions now, please.
Nick, I think we've got time for one question.
One question.
So who is the lucky soul going to be that gets to ask? There you go, sir. You want to reach over, give him the mic?
Hello, my name is Stefan Hermes from the company Horeos. Can you talk a bit more about the aspect of commodity trading and precious metals? Because you mentioned that very briefly in your presentation.
Well, actually, the expert's sitting behind you there. So, we looked at how to the commodities industry in general has some problems with balancing of power, and it's very interesting how a blockchain-enabled world there redistributes the power amongst the full value chain. And I think they've also suffered from a lot of problems with fraud. And there's one example of a major bank losing money because an asset, this is a metals asset, they get given warrants when they get stored in a metal warehouse, and the asset was going in one outside, getting a warrant, and then going around the back and coming in the front again, given the second warrant. So that was a fraud case that was causing a lot of problems. So there's a lot of areas of fraud reduction and redistribution, democratization of power in that industry. It's very interesting. Well, next step is we're talking to many sort of different organizations about that and consortiums around that to see how we can take that forward. The plan is we built a prototype, we built a solution that we want to have a look at how it's mobile enabled as well, based on the Ethereum platform. So very happy to show you through that, actually. Yeah.
Nick Weisfeld from GFT, thank you very much for being with us today on the innovation stage. Nick will be on the sidelines of the stage. If you have a question that you didn't get to ask, he's available. Take advantage of that. Thank you so much, Nick.